Atosha Global Analytics. Please like and subscribe. Greetings, salutations, and howdy to you all. I'm KT with Atosha Global Analytics. As always, Atosha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. Okay, so today we're here to talk about what's called the capital stack, more specifically the lending and equity positions, plus how it may look in the office sector of commercial real estate today. So here we go. First, what is a capital stack? In real estate terms, it is every position of contributed capital that was used to facilitate a real estate transaction. Simplified, it's the value of a property broken into the mortgage balance and the remaining equity position plus costs. It's typically more capital, by the way, than just the property value less the mortgage amount at purchase, because remember, there are other costs that are associated with buying a property, and the equity investors usually pay for those. Of course, both values and mortgage balances will be changing over time, so the equity position naturally changes too. Mortgage balances usually go down. So when values go, when they go up, everybody's happy, and when they go down, people frown. So also, how much and where an individual or a party's position is within the capital stack also means they have different exposures to risk when it comes to values going down, or they may or there's unforeseen expenses. They may earn varying amounts even when the property goes up in value. The nuances of that is something for another time, honestly. But in this video, I'll show a typical capital stack structure, show you how it looks like today for a property bought a few years ago, and give you a couple future scenarios to boot. So here's the basic capital stack. We start with, we're doing an office property here. It was purchased early 2020 for $11,500,000. It praises out at that, and the buyer gets 75% loan-to-value financing with a really good 3.7% mortgage rate. They close on it with, at the time they close, it has 91% occupancy. The property is in a great urban center in a high growth state, and it is seen as a truly solid investment all the way around. The tenants have been there a while, primarily corporate tenants, larger corporate tenants, so the property should be quite stable. The only snag in the process comes when the bank limits the loan to the debt service via the debt service coverage ratio, or DSCR. And that makes the mortgage amount come in at, about $39,000 under what they expected originally. So despite that, it's supposed to be 75% LTV based on the appraised purchase price, they actually get slightly under 75% like they planned. So, the buyer, which, usually this is the way it works, so I've structured it that way without knowing all the details behind the scenes. It's usually a company that they aggregate capital from other private equity investors. In this case, I've selected 3 others and given 3 different types of positions. So in addition to kicking in their own capital, the company that is, they end up deciding to increase their position that little bit to cover that balance, and leave the other equity positions as they planned previously when they solicited those funds. So the positions of each equity partner, including the company that's spearheading the deal, are plugged into what's called a waterfall. Not to get too complicated with it here because it can be very complex, but a waterfall shows the position, the payout priority, the payout rates, the portion of the proceeds that they might get at disbursement periods, and it's for each equity partner. So, waterfalls may involve, those regular disbursements from cash flows as well, usually on an annual basis or something like that, as well as, reversionary proceeds from an eventual sale. So these waterfalls can be quite involved, and it's really beyond the pale for this video. So for this property specifically, we have to kind of lay out how things looked at the time of acquisition so we can look at the revised positions later on and see what happens. So first, the acquisition specifics. Starting with the NOI and the DSCR, we see that the 1.2 DSCR limited the debt service, and that limited the loan to about $7,410,000. From an investment standpoint, that often also limits what the inferred purchase price should be, but neither the lender nor the buyer pays much attention to that, as they really relied on the appraised value. In good times, this is how it often goes, but in bad times, the lender would be a lot more picky. But anyway, the buyer purchased the property at 11,500,000 at the end of February 2020, and trying to keep things rounded as long as I can, I estimated about 5%, acquisition costs. That gives us an all-in cost, and that's exactly what it sounds like. It's all the costs associated with acquiring the property. So the all-in is $12,075,000. The loan amount subtracted from that leaves, $4,664,293, and so I guess that's about it for the rounding anyway. But by the way, please take a moment right here and like and subscribe to help the channel out. Thank you for that. Okay, so here's where I've fully run out of all the known facts, so I have to start creating a lot of things. Here's a really simplified form of a waterfall. We have the full equity position that was supposed to be $4,625,000 originally, but the equity position came in 39,000 higher or so. So we have four positions. The firm has a regular equity partner that typically matches the company's position, usually at about 30% each. But the company had to put in that extra 39 while the partner put in what he previously planned, not rocking the boat, so to speak. So they added capital from two equity investors for the remaining 40% of the equity to create the aggregate equity position. So equity investor number one is at 25% and number two is at 15%. Now, all these positions and the specifics of the investment are typically negotiated, these contracted positions, they're whatever they agree to at the time. But I'm kind of giving you a more typical structure based on, $200 billion worth of acquisition modeling, because I want you to kind of see the different components of a typical capital stack. So equity investor number one, they only wanted to do 20% originally, but the company said that they'd be subordinate in the capital stack unless they were at least at 25% level. So the equity investor said, all right, he raised his position to 25%. So he is on equal footing with the two partners, but they are still proportional in what they would get paid, et cetera. The last guy, equity position or equity investor number two, that position is the remaining 15% of what was left. And he took the deal, knowing that it was a subordinate position to the others, and but he thought of it this way: though he's the last to be paid and the first to take a loss in the event of a shortfall, the returns were too good on paper to ignore. He considered it safe, and he decided it'd be safe enough to proceed. And so I've kind of color-coded the positions here to reference that. The blues are all tied together equally in priority. While equity investor number two is more risky by position, has an amber color indicating caution for that position. And this is fairly typical with different levels of investment in capital stack. So again, a full waterfall would show the priority of all these positions, the amounts contributed, the order of repayment, the amount of pre-tax cash flow they get, and when, as far as disbursements, et cetera. We're trying to strike a balance between a real structure and some simplicity here. So just hang with what's shown here. Again, the transaction is a real one, and I'm generally familiar with the deal, but I don't know the internal waterfall and all the transaction expenses to the dollar. And, I'm kind of creating all this off the cuff, especially some of the future forecasts. And I'm kind of curious how this will all work out. So now, before we jump to the refinance window, let's analyze the waterfall another way. Instead of looking at the percentage of the equity, let's look at the individual positions based on the all-in cost and the purchase price. You see, in this case, the purchase and appraised price were the same. That's not always true. And this will, matter when they review it later on. By the way, first, here's the equity position is 38.6% of the all-in. Second, we see the proportional position for each investor in relation to that all-in. And thirdly, here we have the proportional position of each investor in relation to the purchase price. Okay, well, they got a 5-year term with the mortgage at acquisition, so they intend on a 5-year hold, at which time they will either decide to keep it and refinance, or they will sell it. They typically get about a 6-month defeasance window at the end of the mortgage term, which means that if it's a typical mortgage, which means they can refinance it in the last quarter of 2024 through the end of February. So if values are increasing, they'd probably want to do it a little later in that window. But if values are falling, then they'd want to do it as soon as possible to capture as much value as they can. But before any of that, we need to have an idea of the value. And we aren't to the end of that defeasance window yet. So they closed on this property at the end of February of 2020, and then the economy went nuts, right? So with the government programs and having corporate clients, let's say that they just were made whole. The corporate clients were their tenants. Let's just say they were made whole on the cash flow. There's no way to really know how things may have gotten mixed up during the lockdowns. But since I really don't know those internals and we want to see the impact to the property itself, we are saying that the effective income to the property was at parity during about 2020 and 2021 while they had those programs in place, meaning they neither really benefit or lost money based on all that turmoil. So a reality at the time of refinance is going to reflect that future reality we still have to create here, and the value trends during the holding period are a factor in what they might earn as well. So a lot of fiction here. But before that, let's figure out what they intended to earn. Let's look at a model and see what they intended to earn. And then let's, after looking at the rudimentary model, we'll look at the values and resulting future impacts. So as I move on to that, please take a moment here to like and subscribe to help the channel out. I appreciate that. So here's a rudimentary model. They expected 4% growth to the NOI, which is very standard. Because of that, they expected things to keep chugging along, and so the same 4% cap rate was reasonable. So they would keep it at 4% from acquisition through sale, and using that 4% and the projected year 6 NOI after replacement reserves, they projected roughly a $15.5 million value at the end of the holding period. That's almost 35% higher value in 5 years, and the IRR, or the internal rate of return, that ends up 14.8%. That's quite good. It's not a grand slam homer, but it's a solid return for private equity. But then the reality becomes something a little different here. So back to the value thing again. Here's a table showing the value increasing through 2022 and then reversing and going down again. Of course, this is all forecast for the latter half of 2023 and into 2024. But the office market is really hurting right now, and it hasn't really impacted the economy or the market fully yet. However, reality is becoming more apparent, and the market is shifting. Right now, there are few transactions. Refinance workouts and owners walking away are taking a toll on lending options, and valuations are down in many ways. A few of the drivers of that, lower NOI due to the high vacancy rates, higher interest rates on new and variable rate debt, tougher underwriting standards, and of course, the cap rates are increasing already. So let's just say that this value forecast ends up being perfectly accurate. Lots of fiction. You can see that they were seeing their investment skyrocket until 2022, and then it softens. In 2022, they were still golden. They were up nicely. Huge amounts of equity. However, then things turn and slide back down, as many anticipate. This is a fictional projection, but there are market forces at work here that can't be ignored. So presuming this is accurate, October 2024, the value forecast shown here projects they'll be at about $725,000 or so lower than what they paid originally for the property. And the trend is not their friend. So what do? Well, here's some options. They could walk away. They all lose their investment. Depending on what the property eventually sells for, they may or may not also have the lender coming after them for any shortfall after the sale. Remember, usually REO sales for commercial properties are a little below market. They're not usually as soft as, say, for housing, but it's impossible to know in this fictional world I've created what it could end up being. The only guaranteed thing would be that if they'd be out of most of their investment at a minimum. Again, likely most or all of their investment is gone and possibly have to settle up with the lender again later. So it's not good, but, reality sometimes is harsh, well, what happens if they hold on to it? Well, they know that they are going to have to invest more money into the property. Because they're already at a $725,000 loss. And they need to know how much and have a sense of what the market may do later so they can forecast and value and project returns later. So let's look deeper into what they see when they have to decide in late 2024. As I set up that, please take a moment here and to like and subscribe and help my channel out. I appreciate that. So if it's a typical mortgage that they got when they acquired the property, the opening of their defeasance window is 6 months before the mortgage is due, and they figure they need to move as soon as possible to mitigate losses. They'd benefit by moving ASAP with the intention of closing on a new loan no later than maybe the end of October 2024. So they look at their options, and the lending landscape has changed significantly since they bought. Instead of a 3.7% interest rate, they will have to pay 6.8% interest. A lender is willing to lend on the property, which is likely a whole lot of fiction by itself, right? But staying with this, let's say the lender still has the same 1.2 DSCR, but they can only get 70% LTV now instead of the previous 75. All told, they have a nearly $2.7 million shortfall because of this. Let's look at this from the top down so we can see what really happens. Okay, so here we have the old cash flows and the forecast for October 2024 side by side. We distill this down to the NOI. Note that the potential gross income is still quite high. The effective gross income has really come down. For simplicity, I had most of the old expenses set up as proportional on the left side, but that's not necessarily reality. Some are tied to effective gross income and will definitely stay proportional, but insurance, utilities, maintenance costs, some of these things, they don't care about the income. They're tied to external factors. Also, many expenses are tied to the tenant as they pay them as part of the lease. If it's a triple net lease, pretty much everything. But however, since I translated the costs over to the property here, and the reason I did that is we need to reveal what the property does, as the expenses for vacant spaces, they shift over to the owner. So I associated all the expenses with the owner throughout the entire period. I also tweaked 2024 a bit, in those expenses due to the foreseeable changes. Again, softening incomes, whereas those expenses would be more fixed. So we have some new totals towards the bottom that we need to focus on. And right? So what do? They have this information. The four parties who contributed equity, they need to make a decision. Well, if they stay in, they have to invest more and could actually lose more money because things are quite uncertain. If they bail, they know they will have losses, but they might be able to salvage this over time if they stay. Well, equity investor number two is going from what was already a risky position to an incredibly risky position by staying, and so he decides to write off his loss and just move on. He has that right. Equity investor number one is in a better position, but he also knows that he has to proportionally invest more money. And since equity investor number two is bailing, this means his piece of the pie gets effectively bigger and his risk increases. So he decides to bail on this too. He decides, all right, it's better just to take the loss. And so both those equity investors are signing off their rights and leaving their investment. They're taking a complete loss on their taxes, etc. So what about the company and the equity partner? Well, experienced investors understand that they have risk, but they also know that managing a bad situation may cost them returns elsewhere. That's opportunity cost. But it also, it may also mitigate their current losses by staying in and avoid a default. And by avoiding a default, that will allow them continued lending opportunities in the future. So what happens if they split the additional equity requirements, hold it for 5 more years, and sell it then? Will they mitigate the loss or maybe make money? Well, let's see. Before I rock a 100% fictional forecast model, please take a moment here to like and subscribe and help the channel out. Thanks again. Well, there's 2 things to highlight right here before I share the forecast model. One, the property return model is not the same as the individual returns. I won't be going too deep here and look at the individual's returns, but the property returns and the aggregate equity returns at the end of the second holding period are different because the equity the 2 investors put in is still included in the overall capital stack. So the second thing is that the aggregate equity, forfeited or not, translated into the new model. But 2 of them will no longer be benefiting from that investment as they forfeited it. So that equity literally translates to the 2 partners who continue. Well, that mitigates some losses right there, potentially. Also, please note that this is not factoring in the potential tax implications with the IRS of forfeitures and transfers of this and what have you. That's also too deep for this video. However, here's that fictional model to see what it shows us. Well, they have the revised mortgage. It's much lower, but it's better than nothing. They still have the cash flow proceeds, which actually is forecast to improve. They expect to mitigate some of their vacancy and collection loss over the next 5 years. Also, they ended up at a 5.5% cap rate over time, which is higher than the 4% they bought at, but that's the new reality. So even if NOI goes up around 6% per year, with that cap rate, their value at the end is almost $2 million lower than what they paid. So overall, it's not real pretty. So if they sell at the end of the second holding period and the property is still at a loss over, the nearly 10 years that they've owned it, should they stay? Sounds kind of like they should walk away. A negative IRR is not good, but here's Paul Harvey time. The rest of the story is a tad different. So the equity position as a whole is different than what the property does as the forfeited equity translated to their position. So their equity position provides them a different IRR than the property does. In this case, it becomes a positive 4.2% IRR. That's different than a negative 1.3% return for sure. So the fictional scenario says that if all the parties were staying in, it was probably pretty likely best to bail because then it would have been negative for everyone. But as it works out in this scenario, they'd at least not lose money. So it would be making the best of a bad situation for sure, but not necessarily a great result. If you look at opportunity cost, what they might have earned elsewhere, they probably would have been better off bailing. But in working things out, they also maintain their credit standing and can do other deals. If they're investing in other asset types and are making 15% IRR or so, then this 4.2% IRR, or even possibly the 1.3% negative IRR on the property, it's much better than taking the loss and settling for lesser, more passive returns elsewhere because they won't be able to continue doing deals. So that is something that can be calculated, specifically what the break even might be on this property, et cetera. But you need a lot more number crunching to get there. And this is just a quick fictional thing. So, but anyway, that ended up one really long video, but I didn't want to belabor the subject and split it up into a couple different videos. The capital stack will be covered again in the future, but in different ways. However, this was a cool way to see what it is and to see it in action. And with that, thanks so much for sharing this journey with me, and I look forward to continuing the journey with you in the near future. See you in the next video. Tosha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.